The stock market has officially lost the plot, and the metric that was supposed to keep everyone honest is being quietly buried in the backyard. Price to earnings ratios, the holy grail of valuation for the last century, are either dead, dying, or just really confused right now. For decades, the PE ratio was the bouncer at the club door, deciding who got in and who got turned away. If a stock's price divided by its earnings per share was too high, you were overvalued, too low, and you were either a bargain or a trap. Then, the tech revolution walked in, wearing sneakers and a hoodie, and the bouncer suddenly had no idea what to do. Companies like Amazon traded at 200 times earnings for years, and the people who used that as a sell signal missed one of the greatest wealth-building runs in modern history. So now we have to ask the uncomfortable question: did the model break, or did we just apply it wrong the whole time? Because there is a massive difference between a metric being outdated and a metric being misused by people who wanted a simple answer to a complicated world. Enter the PEG ratio, the PE ratio's slightly more self-aware cousin, dividing the price to earnings multiple by the company's expected earnings growth rate. Peter Lynch, one of the greatest fund managers who ever lived, famously said a PEG below 1 was a screaming buy, and that heuristic aged better than most hot takes from that era. But even Lynch's smarter formula gets weird when growth rates are speculative, when interest rates are doing backflips, or when a company's earnings are negative, but the market is pricing in a $1 trillion future. You cannot PEG what does not yet exist, and that is both the genius and the absurdity of where we are. Here is the macroeconomic layer that most retail investors skip entirely. When interest rates were near zero for over a decade, the discount rate applied to future earnings collapsed, making sky-high multiples mathematically defensible under a certain kind of squinting. The moment rates started climbing in 2022, the same growth stocks got absolutely demolished. Not because the business changed, but because the math changed around them. The psychological damage from that unwind was real and lasting. People who had dismissed PE ratios as boomer metrics suddenly became born-again value investors, while the true believers in growth kept whispering that this time it really is different, which historically is either the most dangerous sentence in finance or occasionally stubbornly correct. Zoom out to the historical cycles and you see this argument repeating like a seasonal allergy. In the dot-com bubble, PE ratios were laughed off the stage. And then the market collapsed 60 to 80%, and everyone remembered why they existed in the first place. What makes today feel genuinely different is that some of the companies commanding enormous multiples are actually generating real revenue, real margins, and real competitive moats, which is not something you could say about Pets.com in 1999. That distinction matters, but it does not mean you get to turn your brain off and ignore valuation entirely. The common misconception worth dismantling is that a high PE ratio automatically means a stock is overpriced, and a low PE means it is safe. A dying business trading at 8 times earnings is not a value play, it is a value trap, while a compounding machine at 40 times earnings might be the most rational bet in the room if the growth runway is long and defensible. The practical lesson history keeps screaming is that neither metric should be used as a standalone trigger, but rather as one input in a broader mosaic. Size your positions with humility, stress test your thesis against a rising rate environment, and never let conviction substitute for process, because the market does not care how right you feel. If you are going to use these tools, use them comparatively, not absolutely, by looking at a stock's current multiple against its own historical range and against sector peers, rather than applying some universal number as gospel. Discipline and consistency in how you apply your framework will outperform any single metric you fall in love with. At the end of the day, PE and PEG ratios are not dead. They are just no longer sufficient on their own in a world of negative rate distortions, AI-driven growth speculation, and businesses built on intangibles that never show up cleanly on a balance sheet. The investors who thrive are not the ones who abandoned the old tools or the ones who clung to them like a life raft, but the ones who understood what the tools were actually measuring and stayed honest about the limits. And whether you are trying to build wealth through equities, real estate, or something in between, we are here to help you take that first step. So check out our links in the description below for real estate investing, home contracting work, and connecting with lenders.